In 1873, a shoemaker called George Bromley married Elizabeth Russell in Lewes. Out of that marriage came a name that would sit over British shop fronts for almost 150 years, Russell and Bromley. By 1879, they were trading under that combined name in Sussex. Through the late 19th century, they grew one store at a time. There was no big venture money. It was family. Apprentices. Long days. They made practical shoes for local people who walked everywhere and wore through soles fast. Then came the First World War. Then the Great Depression. Demand for luxury slipped away. People needed sturdy boots, not fashion. Yet the business survived. It adapted. It tightened costs. It kept the doors open when many others did not. By the start of the Second World War, Russell and Bromley had around 20 branches. Still family-owned. Still focused on quality and service. After 1945, Britain changed. Rationing eased. London became a stage again. In 1947, Russell and Bromley made a big change of their own. They opened a store on Bond Street. That address signaled a shift from local shoemaker to high-end luxury. They were not just fitting village customers anymore. They were serving city professionals, socialites, and visitors who came to London to spend. That Bond Street move started the brand story many people know. For decades, Russell and Bromley stood for polished leather, Italian craft, and a certain kind of quiet wealth. You walked in and you smelled new leather and polish. Staff knew regular customers by name. People went there for wedding shoes, first big work shoes, and important events. By the 2000s and early 2010s, the brand had become a go-to for public figures. The Princess of Wales, Kate Middleton, wore their court shoes and boots. Former Prime Minister Theresa May was often seen in their pairs. Russell and Bromley became a symbol of British quiet luxury. Not loud logos, clean lines, reliable quality. For a while that mix worked, but the numbers started to shift. 2019 was the last year the business made a profit. It earned just under £1 million on about £85 million of turnover. That sounds healthy, yet even then, margins were already tight and the cost base was heavy. Dozens of high street leases, staff across the country, stock tied up in slow-moving sizes and styles. Then came the pandemic years. Stores shut for months. Footfall collapsed. When people did shop again, habits had changed. More buying online. More trainers. Fewer formal shoes. By 2023, the numbers told a hard story. Turnover had fallen about 7.2% to £62.9 million. Instead of profit, there was an operating loss of around £1.4 million. The next year was worse. In 2024, turnover dropped again to about £56.5 million, and the operating loss grew to around £9 million. At the same time, fixed costs kept climbing. Energy bills rose. Supply chains were more expensive. The national living wage increased. Employers paid more in pension contributions and more in national insurance. Business rates and council taxes pressed on every store. Administrators would later point to rising energy prices, a higher national living wage, and higher employer taxes as key reasons why the Russell and Bromley model no longer worked. Inside the company, leaders tried to fight back. In early 2024, they moved the head office to Kingly Street in Soho and shifted the distribution centre to Corby in Northamptonshire. They cut about 8.5% of staff, mainly in distribution and operations, trying to become leaner. They started a 5-year turnaround plan called Reboot in February 2025. The plan focused on brand and product, people, growth and expansion, marketing and operations. They hired their first creative director, Daniel Beardsworth Shaw. They brought in actress Billie Piper for new campaigns aimed at younger shoppers. The goal was clear: make Russell and Bromley feel fresh without losing its heritage. Slim down the back end, modernize stores, grow digital sales. In October 2025, they went to the market looking for funding to push this turnaround harder. But the wider climate did not cooperate. Foot traffic on British high streets in 2024 stayed 15 to 20% below pre-pandemic levels. A survey from PwC and Green Street found that in the first half of that year, about 2,300 chain stores closed on a net basis. That worked out to around 12 closures every day. Pubs, chemists and banks were shutting alongside fashion and footwear. It was not just one brand struggling. It was a pattern. Tax and policy choices added more pressure. In April 2025, the UK government raised employer national insurance to 15% and lowered the threshold to £5,000. For a business like Russell and Bromley, with around 440 employees, that change alone added hundreds of thousands of pounds of yearly costs. Costs that did not bring in new customers. They simply sat on the wage bill. At the same time, the personal tax system started to change how managers and staff behaved. Higher tax bands at £50,000 and £100,000 meant many people did not want extra hours or pay that pushed them into those bands. Daniel Priestley, an entrepreneur and author, described this as a break on effort. He told the story of an employee earning £50,000 who chose to work 4.5 days a week instead of taking a pay rise that would trigger higher tax. Another friend of his paid himself £100,000 in income and pushed another £60,000 into a pension that invested in the United States S&P 500 instead of spending in the UK. Priestley linked these choices to a broader trend. He wrote about a founder of a £300 million AI company leaving Britain because he could not persuade talent to move into what he called high-tax Britain. He pointed to the government raising capital gains tax and then collecting 8% less than before. He compared the UK's top income tax rate of 45% with Singapore's top rate of 22%. Singapore also has no capital gains tax and no inheritance tax. In his view, systems like Singapore and Switzerland show that you can run good public services with lower taxes, and that this encourages growth. In his post about Russell and Bromley, Priestley wrote that the company had survived 2 great wars but could not survive a high-tax, low-growth economy. He told how a friend had moved offices into a new borough just to cut council tax and had stopped hiring in the UK because of increased national insurance. That friend discovered she could outsource jobs to South Africa for less. The point was clear: businesses were reacting logically to the incentives in front of them. Faced with higher costs and thin margins, they shrank, outsourced, or moved. Marketing author Mark Palmer replied that while the current government was not doing a great job, blame should not stop there. He called for longer-term context and mentioned that the decline of the high street had been helped along by past governments too. He listed The Body Shop, Cath Kidston, Laura Ashley, and Debenhams. He cited around 5,500 pubs and bars closing since 2010. For him, this was not just about one tax rise in 1 year. It was about years of policy choices, from selling off infrastructure to failing to invest properly in people and productivity. Another commenter, Paul Anthony Roberts, backed that point and called for more focus on investing in people and their ability to produce more value over time. While that argument played out online, Russell and Bromley's own options were running out. The Reboot plan had not returned the business to profit. High rents, business rates, and staff costs on dozens of stores dragged down the whole group. Maintaining made-in-Italy quality shoes inside a high-cost UK retail structure meant price points that were hard to sustain when shoppers were trading down, buying online, or simply not buying dress shoes at all. By January 2026, the family had taken external advice and reached a hard conclusion. Fifth-generation Chief Executive Andrew Bromley said in a statement that, after a strategic review with external advisors, they had taken the difficult decision to sell the Russell and Bromley brand. He called it the best route to secure a future for the brand and thanked staff, suppliers, partners, and customers for their support across its history. Inside the family, there were reported disagreements about how far to sell and to whom. Some members preferred private equity bids that might keep more stores open. Others saw a full sale as the only way to avoid collapse. On the 21st of January 2026, the company entered pre-pack administration. Insolvency firm Interpath was appointed, with Will Wright and Chris Pole as joint administrators. Next plc stepped in as buyer. For about £2.5 million, it acquired the Russell and Bromley brand and intellectual property. It also paid about £1.3 million for stock. The total deal was roughly £3.8 million. To give that number context, commentators noted that this was roughly the price of a high-end London townhouse. More than a century of history, a beloved brand, sold for the value of a single property. Next did not take the full store estate. Out of 36 standalone stores and 9 concessions, it kept just 3. Chelsea, Mayfair, Bluewater. Prime, high footfall, affluent locations that fit neatly into Next's own strategy. The remaining 33 stores and 9 concessions were left in the hands of the administrators. Around 440 jobs were placed at risk. Some stores, like Exeter and Guildford, started hanging up. Everything must go signs as stock clearance operators such as Modella Capital and Retail Realizations moved in. Will Wright of Interpath described Russell and Bromley as a brand that had been at the forefront of contemporary style across its 147-year history. He said the intention was to keep trading the remaining portfolio of stores for as long as possible while options were explored. Yet everyone involved knew that without a buyer willing to carry the rent, rates, and staff costs of a large estate, most of those sites would go dark. To many, this story looked like bad management landing at the final stop. But the data points show something wider. The firm lost money every year from 2020 onward. Turnover fell from about £85 million to the mid-50 millions in just a few years. At the same time, the tax and cost environment added new weight. Employer national insurance rose. Business rates and council taxes climbed. Energy bills spiked. The British Chambers of Commerce reported in late 2025 that around 59% of UK businesses named taxation as their top concern. These are the brake pedals Priestley talked about. Each one small in isolation, together enough to stall growth. Russell and Bromley did make mistakes. It was slow to build a strong digital presence compared to pure online rivals. It held on to expensive leases while footfall dropped and shoppers moved to retail parks and the web. Its Reboot plan came late in the game. Hiring a creative director and signing Billy Piper gave the brand fresh polish, but fashion campaigns cannot fix a broken cost base or rewrite tax law. At the same time, it is hard to ignore that in the same month of January 2026, other retailers like Claire's and the Original Factory Shop also entered administration. High streets up and down the country showed the same signs. Empty windows, to-let boards, discount chains taking the space of mid-market names. The pattern points to structure, not just one company's poor choices. Next acquisition shows another trend. Large groups with strong online platforms swoop in to buy heritage brands once administrators have stripped out liabilities. The buyer takes the logo, the archives, and a few flagship stores. These can be plugged into an existing warehouse, website, and customer database. Costs that once sat across 40 or 50 sites now sit across 3 and an online store. For the brand, survival shifts from streets to screens. For customers and staff, the experience is different. A Russell and Bromley search result will still appear on Next's Total platform. You will still be able to buy a loafer or a boot with the same name stamped inside. But that quiet moment of being fitted in a long-standing local store by someone who has served your family for years is gone in most towns. The debate around why this happened will continue. Some will side with Daniel Priestley and point at a bigger and more expensive state as the main cause of a low-growth economy. Others will agree with Mark Palmer and argue that longer-term choices, including Brexit, the selling off of national assets, and a lack of joined-up industrial and retail policy, set the stage. People like Paul Anthony Roberts will keep calling for deeper investment in people and productivity rather than headline tax cuts alone. What is hard to dispute is the scale of the shift. A company that began with a marriage in Victorian Sussex that traded through 2 world wars and the Great Depression has been undone in the space of a few balance sheets. Not by bombs or rationing or leather shortages. By slow drops in turnover, rising operating losses, higher employer taxes, energy bills and rates, and consumers who no longer dress the same way for work. Russell and Bromley is not totally gone. As of early 2026, there are 3 physical stores still trading under Next's ownership. The brand lives on as a label on web pages, in warehouses, and in the memories of people who bought their first work shoes there. But the British high street presence that made the name matter has been cut to the bone. In 1873, Russell and Bromley was built on a marriage and a dream. It survived 2 world wars and the Great Depression. In 2026, it could not survive a spreadsheet. When Next bought the brand for the price of a London townhouse, it did not just buy a shoemaker. It bought the remains of a British institution that finally ran out of road.